All right. Well, thank you for joining us today. This is our R&D tax credit update. The title is Best Practices for Filing Requirements and Amended Claims. We're going to talk about that due to the fact that the burden of documentation has really been upped by, I would say, the IRS right now with respect to both amended claims and also in the future, not too far in the future, with respect to currently filed claims on the Form 6765. We're also going to talk a little bit about Section 174. I'll get into this more, but as many of you may have noted, the Senate did not pass. The House passed bill that may have, or that would have delayed the requirement for capitalization all the way back to 22 for Section 174. So there's documentation that goes along with that too, which is why we're going to include some update and some best practices around that. So again, in this session, we're going to explore the increased qualitative and quantitative information required for claiming qualified research expenses and for R&D control group members and how it relates to the current administration of R&D tax credits by the IRS and how it will be administered in the future. Okay, with that said, I'm Marty Kierman. I'm the head of our tax credits and incentives advisory group. And let me start moving these slides so they catch up to what I'm talking about. All right, so we're going to talk today, and I'm going to introduce our director in our group in just 1 second, Vivian Kors, who will be doing this with me. But we're going to talk about Section 41 and the credit and the proposed change around Form 6765. We're going to talk about the amended return disclosure statement changes that took place 2.5 years ago that have recently been updated again to make them a little less onerous. We're talking about 174 capitalization. With that said, Vivian, why don't you introduce yourself to everybody here? I think we have over 600 people, so you can make some new friends here.
I love making new friends.
Yeah.
Well, hi, everyone. My name is Vivian Kors. I'm a director in the Tax Credits and Incentives Advisory Group. I work very closely with Marty, and I've been doing R&D Tax Credits Section 174 analysis since I was an intern back in the day. And I will not tell you how many years. Don't ask, Marty.
I can't even count that high. It's fun. Very well. Okay, so let me give you some background on our group. Tax Credits and Incentives Advisory at Cherry Bekaert is part of our Strategic Tax Advisory Group, which is made up of the Tax Credits Group, the State and Local Group, our International Group, and our Strategic Financing Services Group, which focuses a lot on the New Markets Tax Credit. Our group has just over 50 people with obviously extensive experience when it comes to the documentation and quantification of tax credits and incentives. We focus on R&D, which is probably the largest part of our practice right now. We work with companies that are purchasing and refurbing commercial real estate when we're doing our sort of cost seg studies and 179D analyses. We do a lot of work right now specific to the Inflation Reduction Act, both for taxpayers who are placing into service certain renewable technologies and generating credit for themselves. Also for those that are looking to purchase credits under the Inflation Reduction Act, specifically with a lot of C Corps that are looking to purchase credits to reduce tax liability that way. That's a very big deal right now. We also have some members of the group that focus on both statutory and negotiated state and local credits and site selection as well. So with that said, it's a group that I'm proud to be heading up due to the fact that we house all of the credits and incentives in one group that's well coordinated. And whenever we're talking to clients, we try to identify other opportunities for them beyond what may be there. So for example, Section 174 has required the capitalization, as we talked about briefly, of research expenses, which has driven the taxable income up of many companies. That has then led to the discussion of maybe looking at a cost seg study to do some kind of immediate or soon close reduction of that taxable income through accelerated depreciation. Also, other credits come into play as well, and cash benefits too. So that's where we're focused. These are the activities that generate credit opportunities. And now let's get to the first polling question. It's an easy one. There's no wrong answer. So how did you hear about us? Was it the recommendation of a Cherry Bekaert tax advisor? Was it due to an email from Cherry Bekaert, a friend or colleague? Or a friend of colleague, as this thing says. So if your colleagues have friends, they might be asking you to come. Also, a Cherry Bekaert alumni or a social media post. We'll take a look at that and post those results in a second as they come through. All right. And just for a little bit more background, our group is composed of, as I said, 50 people. We have actually 5 directors, 2 specific to R&D, 1 specific to energy, another specific to our cost seg studies, and another specific to our state credits and incentives. And so we have a lot of heft in terms of expertise that we have done a good job of both developing and bringing in. We've grown quite a bit over the last 4 years while I've been here. So it's been great to work with all these people. And Vivian is a prime example of the talent that we have on the team. All right. I don't know if we're going to show it, but let's move on. All right. So let's begin with section 41. And I think I hand it over to you right now, do I?
Yes, you do.
Very good.
So, again, right, our main focus here today is on R&D tax credits, and we're going to go over a brief refresher as to what R&D tax credits are, without going too deep into it, so that there's some background as to what it is, how it applies, so on and so forth. But some of the hot topics as of right now around R&D tax credits is obviously what Marty has been talking about, the Section 174 requirement to capitalize. So companies who are performing research and development, research and experimentation, all costs incidental to research and experimentation, both domestic and foreign, need to be capitalized and amortized over 5 years for domestic spend and over 15 years for foreign spend. One of the key, confusions or assumptions that people make is, oh, I only have 174 if I claim a credit. That's not the case at all. 174 is a much more expansive test. In fact, you could not have a credit at all, but still have significant Section 174 costs to capitalize. So if anything, the R&D tax credit is more of a reason for you to be performing an R&D tax credit study so that you can pay less taxes, because with the add back, you would have, you would either come out of losses sooner or you would potentially be paying more taxes. Another area around the R&D tax credit is disclosure requirements, both in amended claims as well as going forward on your currently filed Form 6765s on your tax return. The trend here is that there is additional disclosure requirements that are needed. Back in the day, you could amend your R&D claims without providing much of the R&D qualitative details, so to speak, but that's going away. And then beginning in 2025 tax years, there's going to be increased disclosures that we're going to talk about, specifically what kind of disclosures related to the Form 6765. On an exciting news, companies can offset up to $500,000 of payroll withholding taxes instead of income taxes for eligible startup companies. That cap used to be $250,000. So starting the 2023 tax year, that has upped to $500,000, which is very exciting for startup companies who qualify, as that's like way for companies to immediately monetize their R&D tax credits if they're not currently taxable. And then some of the hot topics related to looking at prior year returns would be filing amended returns to the extent that you would want to retroactively elect ASC, because there is 2 ways to calculate the credit. And obviously you want to evaluate which way is more beneficial. Your default is the traditional method, but you could always elect by amending your tax return. And then companies moving away from contingent fee providers so that, more of a full service, looking at big pictures, looking at 174 costs outside of just R&D tax credits.
Yeah, and I'm going to interrupt you for a second. I've noticed a lot of these. I don't know if it's the contingent fee providers, but there is, as you said, this misnomer that, like, if I don't identify an R&D credit, then I'm not going to then clue in the IRS that I have R&D, and therefore I don't have to capitalize. I promise you, if anybody on this is getting that kind of advice from anybody, we'll be happy to take a second look. As Vivian was saying, the capitalization is mandatory. We have even seen information and document requests from the IRS specific to 174. So again, this is about documentation. And so we know exactly what they're asking there as well. We're going to see more of it in the future. I know that. The IRS has been busy with things like ERC and some of these disclosure requirements, but the area that I feel that they will focus on for companies is whether or not they're capitalizing. And so it's a big deal, and we'll get into that. All right, Vivian, sorry to interrupt.
Not at all. So brief refresher on what the R&D tax credit is. Generally, when we talk about Section 41, that's the federal tax credit that is designed to promote increasing domestic research and experimentation costs. There are also certain states, more than half the states, offer research tax credits. Each state has slightly different rules. That's what makes our job so fun and so interesting. So some states like Virginia, you would have to apply. The application deadline for Virginia is actually coming up September 1st. So if your company hires a lot of people in Virginia doing R&D, this is the time to look at it now, because one, the Virginia DOR passed the law where they're increasing the pool of the minor credit. So that's the refundable portion. They almost doubled the pool from what I recall. So there's going to be potentially more awards in the minor credit pool. And other states like Maryland, that's a November application deadline. California offers a lucrative incentive. Georgia offers the R&D tax credit that can be utilized against Georgia payroll withholding tax. So that's an immediate way to monetize as well. The Section 41 federal tax credit is a general business credit that is a dollar for dollar reduction in your tax liability and can be carried forward up to 20 years if you can't use it in your current year. And companies receive R&D tax credits for research and development costs incurred in the US, meaning boots on the ground, your resources need to be physically located in the US for the costs associated with them to be credit eligible. Like we mentioned before, there are two ways to calculate the credit, and it's important to look at it on an annual basis because depending on the trend of your R&D spend, one way is going to be more beneficial than the other, or how much gross receipts you have, how high your base is. So the key here is you can go back and capture your current year and prior open tax years credits to the extent that you have losses. For example, if you're a C Corp with losses since inception, we can potentially go back all the way to the beginning. So it's a big bang for your buck if you're in that particular fact pattern. So what qualifies for the credit? And Marty, we can move on to the next slide. Generally, there's a 4-part test. For internal use software, there's a 7-part test, additional scrutiny around that. But generally, it's the 4-part test. Folks always think, hey, I need to be wearing a white lab coat, curing cancer, in order to generate an R&D tax credit. That's not the case at all. All you would need would be your activities, because it's an activity-based credit, to meet the 4-part test that's shown here. So the first 2 tests are kind of the easier ones where, hey, to the extent that we're developing new or improved product functionality, performance, reliability, and or quality, and your activities rely upon a hard science, meaning, hey, we're not looking at, aesthetics, social sciences, marketing. Those are the more easily met tests. The last 2 tests are more, it's more gray. The IRS focuses on these more because it's more gray. But the elimination of uncertainty is saying that there is technical uncertainty as it relates to the capability, method, or design of the product. So capability is, hey, this is so novel, we didn't know if we could get this to do X, Y, Z. Method is, we knew we could eventually get there, but we weren't sure what the best way was to go about development. And then design, that's the straightforward one. We weren't sure what the optimal design of it was in order for it to be most performant, for example. Then through a process experimentation, your company's evaluated more than one alternative to try to resolve the technical uncertainty. So again, your activities by business component, which really means your tech stack, for example, your platform or your particular product line, needs to meet all 4 parts of the test. This would generally exclude maintenance, your production, tech support time, anything that's really QC oriented as opposed to testing. So, hey, we designed this manufacturing process and we have to periodically QC to meet FDA regulations. That would not be an example of qualifying work. And again, foreign work would not be qualifying. Then comes what types of expenses would generate.
I'm going to interrupt again for a second here because it relates back to something we're going to cover later. We talk about this as an activity-based credit. We are focused on essentially individuals, whether they be contractors or their employees of a company, engaging in a process of experimentation to eliminate uncertainty. But this first test here, the business component thing, when it talks about the permitted purpose, looking to create a new product process or design, one of the things that we're going to talk about in some case law that came up later is that the taxpayer really failed to associate the costs with a particular project or business component and really just left it at an activity level and really did less than that. Honestly, they just sort of put a percentage of time that the person spent performing R&D, defined it just that way, as opposed to not R&D, and multiply that percentage by the wage, as opposed to having a set of defined activities of the types of R&D and then having that roll up to the project and the business component. You'll see that that is really what the IRS has been looking for years. And it's something that I'm surprised when I see studies that don't include that still, even when I see case law. Some of these cases date back to like years 2018, 2019, but it's been standard practice for practitioners back to like 2010 at the very least to do that. And so, sometimes when I'm talking to clients, like, well, what's so difficult about this? You really need to, and again, it's documentation, having a process together to associate your costs with a particular project and particular activities and have it all rolled together and say one pivot table that does all of that. That's great for purposes of proving that you have R&D and what that R&D is related to and how much each individual employee spent on that. So I didn't think I'd interrupt you so much for the 4-part test, but you're never surprised by this. So anyway, here we go.
Always welcome.
Yeah.
But again, right, to reiterate, it's establishing the nexus between qualifying activities to the qualifying dollars. So this is the dollars portion. And how do we tie that back to the activities portion? So qualifying research expenses, which is really what generates the credit, generally for your employees, it would be W-2 Box 1 wages. And we establish the nexus between qualifying activities, qualifying dollars by looking at either time tracking data, or we would provide a time survey where we customize the activities based on either the business component or your company, broken out by business component to essentially get that nexus and documentation. Supply costs would be your materials that are consumed in your development process or prototype costs. Extraordinary utilities, to the extent that you need to be running XYZ trials and there are a lot of water or electricity that are consumed as part of that process. Your cloud hosting costs for your dev environments are part of that. And then your contract research expenses, which is your domestic third-party vendors who you're paying to perform or support you in your development initiatives. So generally, those types of costs would be part of what generates a credit for the company.
While these are the costs for our credit, we go a little deeper even when it comes to 174, for example, on the wage side of things. Yes, the credit will include taxable wages, which is roughly equivalent to Box 1 W-2, but the 174 analysis includes all potential wages paid for R&D activities. And so that's the gross wage. And really, that's just a way of saying whatever you identify as a qualified research expense, invariably, the amount of 174 cost that cannot be deducted but has to be capital and amortized will likely be higher than that Section 41 costs from this particular data pool. I'm trying to move the slide.
Yeah, all good.
Yep.
This is our typical information request for our R&D estimates, R&D scopes. Obviously, if you've done a study before, we want to make sure that we're reviewing the work papers to make sure, one, the methodology is in line, and two, how can we improve that or try our best so that we can figure out if there's any areas that need additional documentation. We ask for W-2 wages. That's always going to be, actually, in fact, in an IDR, the IRS asks for W-2 copies of your employees and kind of like job title descriptions of their jobs. So these are all the types of information that we'll ask for. The general ledger data would be how we tie that back, again, establishing the nexus between qualifying dollars and qualifying activities, how we tie that back to your supplies and your cloud costs and your contract research expenses. And then to the extent that you perform contract R&D. So if you're a government contractor or you're a professional services firm where you're maybe hired to do R&D, we ask for sample contracts to ensure that rights and risks are met. There are additional stipulations for funded R&D, so to speak.
One thing on here that it mentions is time tracking data. I don't want anyone on the call to think that not having a time tracking system in place is in any way fatal to not being able to claim a research credit or identify your 174 cost. But you will notice when we talk about it later in this Kyocera motion to dismiss, the government mentioned that the company did not have time tracking data. Personally, from what I could read from that, the company didn't really try to prove that they had much. And so having time tracking data is great, and it's wonderful contemporaneous documentation of what people did by potential activities. But we're always of the mind that none of these time tracking systems are put in place to necessarily claim an R&D credit. So they may always be deficient or not exactly right in some way. So it is perfectly fine to add to it, perform surveys, do additional investigation beyond the time tracking to make sure that you're picking up all the correct amount of expense or expenditure related to your R&D.
Absolutely. And then going back to this, there are two ways of figuring out your R&D tax credit. The first way is the traditional method, regular method. This is what companies default upon. So it is an average annual gross receipts multiplied by your fixed base percentage. This method, I would say, yields a credit that would potentially be more beneficial if you have one, lower gross receipts, two, you have lower, like you have declining R&D spend. That's potentially where this method would generate a better credit. ASC would really come in where you find yourself in a year of spike, or you have, smaller base years, so to speak. My prior 2 years were significantly smaller because we were in maintenance mode, for example. Or, we had a rough year, it was COVID. So that would be when ASC method, the alternative simplified credit method, would potentially generate a bigger credit. And again, it all depends on the facts and circumstances of your company. And it would definitely be our job to evaluate both ways to see which way would make sense. And I think with that, that brings us to our second polling question, Marty.
Question two, do you utilize a professional firm to have an R&D study performed? Would you like to? Because we'd be happy to. With that said, the responses are yes, no, or we do the R&D calculation in-house. Just going back to the math on Vivian's last slide, sort of the quick way to figure out like what your credit may be. Think about something like 10% of what your overall R&D spend may be. That would be a good proxy for what it may. It could be less, it could be a little bit more, but I think that that's a good way to think about like how big this credit is. I deal with a lot of companies who sort of came off working with this employee retention credit where you're getting something like, I don't know, like 50% or 10, like a very large percentage of the amount you spent on an employee during a particular period, then repeated quarter over. This seems like in some ways smaller, or just mathematically it's smaller than that, but it is something to keep in mind that that's about how much credit there is to go along with that. All right, so we'll see how this comes in. Yes, no. Yes, 34% do. No, 40% do not. Again, for the yeses or the nos, or for the ones who do it in-house, always feel free to call us. When it comes to scoping these analyses, we generally do that for free. We want to, especially those that are working with contingent fee providers where they may have had large credits and then suddenly they are stuck with a lot of capitalization. While by no means is, as we said, the credit creating the capitalization requirement, the best way to come up with the most reasonable method to minimize your capitalization comes from doing an R&D study and doing that investigation to see exactly who is and is not performing R&D across the organization in a very refined way, so that you can then develop a most reasonable method to include other expenses, but not too many of those other expenses. And so that's sort of the trick to it. It's understanding exactly what you're doing from an R&D credit perspective and activity, and then using that data to calculate capitalization, but keep it as small as possible. All right. And this is me, right?
It is. And
great.
We would like to see your beautiful face, Marty.
Sorry about that. Let me see what I can do about that. I think I've made most of it me, so that's okay. I've been talking a lot. Okay, so this is an important development. I really feel the Form 6765, and I have a copy of the new one, is the form on which you report your research credit from a federal perspective. It never had anything other than pick this method or that method and do the calculation one way or the other way with the numbers, traditional or alternative simplified, and then report that credit on there. And then maybe if you're going to make an election in your first 5 years with gross receipts, if you have less than 5 million, if you're qualified small business, to utilize some of the credit against your payroll tax. That was really it. And then it flowed into the Form 3800, which reported your overall general business credits and looked at how many of those credits could actually utilize in a particular year. As of June 21st, the IRS released a new Form 6765. It takes effect for calendar year companies. Think of it as coming into effect for the tax year 2025. So we've got this year, it's 24. We'll go through another cycle of filing where this particular form will not be required, but it is not particularly dissimilar from the methodology we have followed anyway when we do our studies. And so all the information we would capture in our study is information that can be easily translated into the new form. It is going to require much more disclosure around what the particular expenses were specific to a particular project and how many projects there were and what kind of project that was. So with that said, the new changes around 6765, and I would say that we're now in year 3 of 174 capitalization, the expertise that we have developed around what does and does not need to be capitalized, especially sometimes if you're doing research on behalf of someone else, you really want to take an analysis of whether or not you actually have to capitalize those expenses. It's a long way of saying I'm going to get to the rest of this form right now, what the changes were specifically. Okay, at the beginning of the form, it really just asks, and this was typically at the end of the form, whether or not you're going to make an election for the reduced credit under Section 280C. Historically speaking, when there was no capitalization requirement around R&D, you would have to reduce your deductions by the amount of your R&D credit. So you weren't getting a credit and a deduction on the same amount. Credit was much more valuable. But when you had a credit of, say 20%, it would have a net value of something less than that when you actually net affected it for tax. It's almost as if you're taking some of that credit into income in the year you're looking at it. But IRC 2 Section 80C was amended under the Tax Cuts and Jobs Act when capitalization hit, that it really only applies when your credit exceeds the amount allowable as a deduction for your qualified research expenses, which doesn't happen very often. At least especially it hasn't yet. We may see more of that coming on as there's more capitalization, as more amortization starts to flow through. But in the first few years of capitalization, it really hasn't been an issue. So many companies have just been claiming the gross credit, which has been permissible. So technically speaking, the credit has increased from a net benefit perspective, which has been a little bit of a help to companies, despite the fact that capitalizations come in. With that said, you're going to identify at the beginning when you're making a 280C election, you're going to identify at the beginning whether you, as a taxpayer, are part of an overall control group of companies, meaning that the research credit requires companies to look at the whole ownership structure. And if you're more than 50% controlled by the same 5 or fewer individuals, ultimately, you have to look at these different companies together as you do your credit calculation, and then allocate that credit back out and report it that way, which is another reporting requirement that may show if you're part of a control group that will, and you check this box, it will clue the IRS into why the amount of expenses don't exactly tally to the amount of credit maybe that might, if you were a standalone, because there's a separate allocation that has to happen when you're part of a control group. All that will be documented in our study accordingly, but it puts them on notice that you're part of a control group. So we can look at both the company that they're analyzing, potentially another company as well that may come together. Section A, both A and B. A is regular credit, B is alternative simplified. They no longer have the lines repeating about what the qualified research expenses were. Those are down in a lower section where they're only reported one time. Section C isn't too different. It just overall shows what the credit is. Section D is now specific to the qualified small business. It's where you make your election to take your credit against payroll tax, and that payroll tax is something that can be offset by the credit in the quarter subsequent to the one in which you file your income tax return. So sometimes there's a benefit if you need it for payroll tax perspective to get your study done early and your return filed earlier, so you can start to take the benefits of that payroll tax in a more current or a closer quarter. Section E, and again, I have these in here, but the taxpayer now has to enter the number of business components generating qualified research expenses. So think about just like what the number of particular projects there are, or particular endeavors or initiatives there are. And I generally like to name them in a way that's most associated with what actually the activity and the product or project was about. And then section F is a qualified research expense summary. It's now a separate section, as we talked about, that flows back into the credit calculations. Yeah, so section G, this is new, and this is where the taxpayer has to furnish the control group member conducting the research, the business component names, the component type, whether it's software or something else, information regarding the software being developed, what was sought to be discovered, and then the wage queries by project or business component, and whether they are for the direct performance of research, the direct support of research, or the direct supervision of research. This is very much doing a lot of the work that we would have done in a study to help explain to the service if they had a question. They always want to know what's direct support, what's direct supervision, and direct performance, due to the fact that I have found during exam, they may want to question whether or not it was true direct supervision or direct support. And it wasn't just picking up queries that were unrelated to the overall endeavor. It's going to be easier for the service then to see exactly and potentially make adjustments, because you're self-disclosing in this particular case how much is direct supervision and direct support. Essentially, you're giving them the roadmap to the audit, but you shouldn't be afraid of that. You should just document it, and that's the whole point of what we're talking about today. It's an optional section for taxpayers with queries less than or equal to 1.5 million. And if you also have less than 50 million of gross receipts. So it doesn't apply to everybody, but I still suggest that even if it doesn't immediately apply to you, every business is intending to grow. And so you should start to think about what you need in order to get this at some point in the future documented appropriately so you can file. You should report 80% of your queries in descending order by the amount of the queries by business component. So basically, you're like listing the top projects for them to analyze. All right, and here it is. I thought it'd be helpful to stick it in here so that you can see the file. As you can see at the top here, A and B talk about the 280C election and whether or not you're part of a control group. Your credit section C. Your election as stated with section D for the payroll tax offset. But most important here is section G, which they provide some amount of the form and the template they would like to have as you're identifying which control group member did it, its EIN, the business component name, the business component type, whether it's software, and describe the information sought to be discovered. It's going to be very important that you have an answer to all of these. It doesn't have to be exhaustive, but I think the better this is filled out and you do your homework for the IRS a bit, you're going to get a much easier pass and less scrutiny. And just to let you know as well, this is not too dissimilar from what foreign countries have been doing for a while. Many of the foreign countries adopted a credit similar to ours and then added more disclosure up front. We're kind of coming in late on the disclosure side in terms of what gets filed with the IRS. So it's not like the IRS or the US is being more onerous about taking a research credit. In some ways, they're just kind of catching up to what the rest of the world is doing after the rest of the world copied us for having a research credit whatsoever. Okay, polling question 3. And also, I talked about a lot of stuff, and we did there too. If anybody has any questions, please feel free to reach out to me or to Vivian after this, or put something in the chat. But does your R&D process collect the information necessary to fill out the new form 6765? Yes, no, or I'm not sure. You may not know. If you have a study that takes place and things are captured according to business component, it probably does. but you're really going to want to think about like you're going to want to get every business component. You're really going to look at how big, how many there are, get them listed in descending order to figure out how many you have to report. Um, so
And
that would be, so go ahead.
Marty, we have a few questions.
Let's go for it. Let's play the lightning round.
Yeah. So how do you document and support the amount of money paid to an outside consultant?
Absolutely. Do you want to take it or me?
Up to you.
Why don't you go? I don't let you talk enough.
Yeah. So I always start with general ledger details
Yeah.
and invoices. It depends on the amount that we're talking about, especially paid to an outside consultant. So if it's something related to, hey, we're paid $1 million to this outside consultant, I would say let's look at the contracts because rights and risks are extremely important in that context. But always start with the general ledger details, vendors, names, and then it would be, okay, how much, again, establishing that nexus between the qualifying dollars and the qualifying activities. So what did this vendor do, or what did this third-party contractor do? Was it related to, which business component it's related to? So it's all documented starting from the general ledger, and that's how I would recommend it. And then to the extent based on dollar amounts, pull the contracts, document that the particular vendor doesn't bear the financial risks, that the taxpayer bears the financial risks, and that the taxpayer has the rights to the development.
Yeah, and one thing to keep in mind too is when we're looking at 174, which you'll talk about, is like from a credit perspective, you can only pick up 65% of those amounts paid to third parties, whereas 100% goes in for 174 analysis. And then also you have to look at whether it's the foreign stuff doesn't go into the credit, but the foreign stuff does go into the 174 analysis.
Yeah.
And you mentioned looking at the contract to understand whether or not there were rights and or risk associated with it. What we'll talk about later in this Betts case, as well as the company really didn't take a good look at the contracts for their third-party consultants doing some of the work. And so it found that actually some of the research probably really relied on the contractor and not them. So this is another thing from a documentation, but really a homework perspective to understand exactly whose credit it should be based on who has the rights and risk. What might the next question be?
Someone's also talking about how should the four-part test be documented. We're just on a documentation train now. So we would recommend project narratives be created so that summaries or example of details of how in a particular tax year, each of those tests are met. So examples would be, hey, what were some of the technical challenges that the team was trying to overcome? And what particular tests were performed, alternatives were considered, why those alternatives didn't work. And that would just kind of be in a document, like a Word document. But what's most important in addition to that would be contemporaneous documentation that's created by the development team. So sometimes it could be a POC test result run, right? Or it could be maybe a test plan that you had. It could be your project plan. It could be PowerPoints to the board, for example, that kind of showcases timeline of your development, so on and so forth. So those are the types of contemporaneous documentation that we would also recommend collecting. There's a question about gross wages, not W-2 wages. We'll touch on that. The gross wages are related to 174. It's really loaded employee costs. So gross wages plus the fringe benefits associated with that particular employee to the extent that you're doing specified research and experimentation. That will be for the capitalization 174 purposes. The W-2 box one wages is for the tax credit calculation purposes.
Is that all of them?
There's a lot more, but I think we need to try to cover more slides. So when we do another poll, we'll come back.
Okay, great. Here you go.
Perfect. So again, right on discussing more on disclosures, back in 2021 of October, the IRS released a Chief Counsel memo that required additional disclosures related to amended refund claims. So amended refund claims related to the R&D tax credit. So starting January 10 of 2022, taxpayers are required to attach an additional statement that provided 5 items that could kind of provide more project details. So examples would be, hey, who was performing the R&D activities, what information they sought to discover, what are the business component names, what research activities were performed on each of those business components, and then the qualifying research expenditure summary. That was a new requirement back in 2021. It's been in place for a while now. The latest update, I would say, would be in addition to extending the time period, the transition period for the 45 days to perfect the claim to January 10th of 2025. So we still have a little bit more time, 4 or 5 months, 4 months. There was a reduction in the amount of information to provide, which is great. It went from 5 items to 3 items. The 2 areas that it got rid of would be the who performed the qualifying research activities, and then what information was sought by each of the individuals to discover. So however, there is still 3 items that the IRS requires as part of this, but that is a reduction in the amount of information that is required as part of the disclosure statements.
I'm trying. One sec. There you go.
Perfect. Oh, we touched on this a little bit. I just want to be conscious of time because we only have like about 18 minutes left. But the last point, I think, are some of the, sorry, if we go to the next slide, some of the key trends that we're seeing is there are some processing issues that we're seeing from the IRS where the taxpayer attached a statement, but the IRS is saying they never got it, or that the timing of the 45-day letter is off, where the taxpayer will receive the 45-day letter like day 43, and then it would expire in 2 days, so to speak. That's something that we saw. The response from the IRS on the 45-day letter is what we've seen is generic statements that don't really provide what was particularly deficient about the disclosure statement or in the claim. That's an area that we're hoping the IRS could provide more guidance on, like, hey, is it, this particular section that you're looking for more information, or, XYZ. So that's an area that we're seeing. But overall, it's definitely an increase in the amount of information that the IRS is seeking, either in an amended refund claim or currently filed Form 6765, and that's definitely the trend that we're seeing now.
Okay, we'll talk a little bit about case law, and by a little bit, I think I can cover it somewhat quickly. Just wanted to make you aware of one motion to dismiss in a case which is specific to Kyocera. This is down in South Carolina. Essentially, government argued that the credit based on employee interviews where they had essentially 36 employees speak about 1,200 people, and really not provide much more documentation than their recollection of who did R&D without really allocating up to a business component on an amended return claim. This has not been decided on. This is just kind of like current right now. A motion to dismiss was filed by the government to dismiss the entire credit claim for an additional 1.3 million beyond the, I think it was initially like 400,000 that the company put on its originally filed return. Big Four came in and said you can actually get 1.3 million more. And this was all sort of overall in the context of a company that had, due to some of the tax law changes, gotten a large payment back from the service. And so this isn't just in a vacuum and looking at R&D, looking at the whole amount that had been refunded back to this company due to some changes in the tax law, Tax Cuts and Jobs Act. Nevertheless, with that said, the government is arguing here that they didn't really put forth enough documentation to support on a contemporaneous basis that this company really had R&D associated with particular business components. Normally speaking, companies can rely on what's known as the Cohen rule, which comes from the case which says that estimates are reasonable and allowable to the extent they're based on something, shall we say, reasonable, right? Here, essentially, the IRS is arguing, the government is arguing that they really didn't have even enough documentation to make an appropriate estimate. There's no guarantee that they're going to win on this, and they may be able to develop more facts as this goes to trial. But I just wanted to make you aware that, again, this comes down to documentation. I don't think this is necessarily the IRS taking a super hard line. I just think they see where a number of their cases, like Little Sandy Coal, have focused on the need for documentation and the need to report things by business component. That they don't want to rely on just hearsay of one person talking about like this 600 group of people and another. They want more than that. They want, if you have time tracking, use it. If you don't have time tracking, develop a reasonable survey that associates individuals' time with with particular activities. If you have 1,200 people, maybe go to 36, maybe go to more than 36 people. So you're getting enough granular detail, especially if you're going for an additional 1.3 million. So it's not a small claim. It's not massive either, but it is something where the IRS has hung their hat on the fact right now in its argument that there's not enough documentation to even provide an estimate, and the taxpayer didn't do their job. They also didn't keep notes of their conversations with the 36 people, nor did the work product of the study do that either. So in some ways, I think this is like sort of a bad study, and I think it's just not providing enough documentation to the service, but we'll see what happens there, and we'll come back to you in our next one on that. The other one was just bets, which was last year, which my biggest takeaway from it is twofold, I suppose. This is a company that included a large number of pilot models in its research credit calculation, basically saying a lot of what it was doing was first in kind. And this is for air filtration systems and oxidizers. The issue is that they really didn't do any of the testing on it until it was in post-production. And so the IRS kind of came back with the idea that like, well, you really should have been testing this ahead of time if this were truly a pilot model. The other thing as well is that the taxpayer did a lot of this through third-party contractors, and they did not do the analysis of whether or not they had the credit or it should be the credit of the contractor based on the risk and rights associated. But the biggest thing and the biggest takeaway in here that I've been kind of harping on to many clients is the court, in a footnote, basically like dismissed the reliance on the consultant's report that it was reasonable because the consultant was getting paid under a contingent fee arrangement. Generally speaking, the service, and this is a court though, has been suspicious of third-party consultants that do this work on a contingent basis because they're incentivized to increase the credit, to increase their fee. And that's why companies like Cherry Bekaert and anyone in the accounting firm profession, due to Circular 230 prohibitions, are not allowed to do this work on a contingent basis, which is why we do a good amount of upfront free scoping work to figure out exactly how large this credit within a reasonable range is to be, and then come up with an appropriate work plan to document it. Generally, our fees also come out to be lower than those contingent fee providers as well. But my big takeaway here is like, and again, to everybody else out there, avoid the contingent fee providers if this ever got contentious, because you now have case law indicating in a footnote that the court was skeptical of the reliance on the report due to the fact that it was done under a contingent fee arrangement. All right, polling question 4, the last one, but don't hang up, we have more. All right, in 2022, did your company capitalize qualified specialized research expenses in conformity with Section 174? This is what Vivian's going to talk about a bit more now. And she's much better at it than I am because she's been much more boots on the ground in some of these research credit studies over the last few years than I have been as well. Any more questions we want to hit?
Yeah. So we have one where assume you are a C Corp that has been in continuous losses, not a qualified small business, never claimed a credit, and they're better off using regular research credit method. Is it Cherry Bekaert's general position that the taxpayer would not be required to file amended returns in order to establish those credits on a credit carry forward schedule?
It's not just our position, it's generally the position of the IRS as well. So you can go back and report them on the currently filed return. However, the most important thing to say, the assumption in there was that you would be better on the traditional method. I don't know if that really holds true for most companies as they go forward in years. It makes the most sense to do an analysis back a few years and see if ASC would have gotten them a better answer, and do an amended return back to the first year within a 3-year statute where ASC worked and move over to that method. That assumption, the question said it didn't apply, but I've never found that necessary to happen, especially when you're moving to more current years.
That's true. And I think that's also part of what we do is when we look at this, we look at it both ways in terms of the regular method and the ASC method. And there's also an ROI, right? Like, is it really worth amending a return just so you can get $20 more using ASC? So we do all of that analysis and take it off your hands and recommend the best course of action.
But you really only need to amend one back 3 years if that's the first year of work. And then if ASC works for the other ones, you can then report everything on the most currently filed return. Anything else in there right now?
Yeah. So if you do not have time tracking data, what should you make sure to document within your employee surveys to substantiate their QREs?
I'll let you do this one.
So I would say again, right, the time survey approach is an acceptable approach as long as you're breaking out a person's activities by the different buckets of activities and by business component. Um, in addition to having the time survey, what I've also seen in the years would be having sign offs, for example, on design documents for some of the supervisors, or having calendars. So, hey, XYZ person meets, 5 times a week to discuss designs or to review testing results. Having like a calendar export that kind of shows their time involvement in XYZ, I think that would be super helpful as well. And just given time, we have to make sure that we're getting through 174. A lot of this we've covered before in our various webinars, but again, it's it's not new. Section 174 has been around for a long time, but the requirement for taxpayers to capitalize and amortize, that's what's new. So requirement to capitalize domestic spend and amortize over 5 years, and foreign spend to amortize over 15 years. Unfortunately, it's still in place right now, given that the Senate vote um, failed to move that forward. And then we can kind of jump a few slides to get to what types of costs is specified research and experimentation expenditures. So again, what we start with, right, is what's QRE, which is going back to the R&D tax credit. What is qualifying research expenses? For example, on the R&D employee costs, in addition to box one wages, you're really starting at gross wages and your benefits. So your workers' comp, right? Like your dental, health benefits, payroll taxes, that's all your loaded employee costs. That goes into 174 versus your credit is only W-2 box one. Your US contractor costs, for example, your credit, you have to take a 35% haircut, but for 174, that's taken at 100%. Funded R&D is going to be a huge area with Section 174. So within the R&D tax credit, there's a notion that taxpayers must retain the development rights and financial risks of the development in order for it to be their credit. However, for 174, you only need either rights or risks for that to be your 174 to capitalize. So that potentially presents an issue with double capitalization, both parties needing to capitalize because you can share rights, for example. You can't share risks generally. So funded R&D would be a potential area where you would have to evaluate outside of your R&D tax credit. Foreign costs would be an area that you would have to evaluate if any of these costs are related to specified research and experimentation as opposed to R&D tax credits. Other costs such as utilities, overhead, rent, those types of costs would also be incidental to R&D to the extent that you're utilizing property that would be part of your specified research and experimentation. So those are all things that, depreciation would be another area where you're looking at depreciation of your R&D equipment, for example. That's not credit eligible, but because it is incidental to R&D, those types of costs would be incidental to R&D. Another area that we see for government contractors and professional services would be your other incidental costs. So maybe rental of your equipment or maybe some of your travel costs to go to a particular area to perform R&D. Maybe you're building a ship and you needed to travel to a particular shipyard. That travel cost would be incidental to R&D and be included as part of your Section 174 cost capitalization.
Right.
I'm just flying through these. I would say big picture wise, administratively, if you did not capitalize in 22 and include that statement to get on the correct or appropriate method of capitalizing 174 in your 2023 return, you are required to file a Form 3115 in order to get on the right method of accounting. So a Form 3115 is your method change form. It is an automatic method change. There is no audit protection for the Section 174 automatic change. However, that's definitely the right method that you would have to get on, and that's something that we can definitely help with. I love Notice 2023-63 because it does provide a lot of guidance as it relates to 174. In fact, it's one of the first pieces of guidance that we got related to 174, what is considered specified research and experimentation costs as opposed to not. I would recommend giving it a look. It defines software development costs. So maintenance, to the extent that the code changes, although writing code does not arise to a level of improvement, that's considered maintenance and not 174, which is great. It also clarified the funded research portion, so research performed under contract. That clarified rights or risks. So Notice 2023-63 does provide a lot of guidance related to 174.
Just to remember on the history here, tax law changed in December 2017, and it took effect in 2018 for everything else other than the capitalization that began in 22. The IRS didn't give us anything until September of 2023. I remember calling you that day to like go over the stuff I was reading in the morning. That's what some of the hiccups have been around this thing, is that like if everyone assumes it's going to get legislatively pulled out of the law, and even the IRS fails to act to provide guidance, and nevertheless, we're sort of left in the position to do our best to figure out the most reasonable method. Fortunately speaking, I think we got it 90% right as we were working with clients. There were no easy ways out of capitalization. There really was some better analysis given here to who had to pick up, looking at potential for double capitalization where research was done on behalf of someone else. The rules were clarified in ways that we didn't exactly expect in that way. Maybe I don't know if you're going to get into it or not, but like you got 2 minutes, so there, go for it. So
The rights or risk part is what you're talking
yeah,
about?
yeah.
Yeah, so we kind of got into that a little bit, but basically if you bear either development rights, so hey, I have the patent rights for this IP, or IP rights, for example, or even in a situation where it's you're all part of the same control group and it's like an international CFC, the CFC has the rights and your domestic entity also has the rights. That's a potential area for double capitalization. The financial risks part would be if you're paid under T&M, for example, generally that would say, hey, I don't have financial risks. But if you have patent rights, that you are still required to capitalize and amortize your specified research experimentation costs, although you're not able to claim that for R&D credit. So that's just something to keep in mind.
Biggest deal is that all software development is without a doubt de facto R&D for this. And so for software development companies, it's a big deal to understand, even if you're not paying a credit, to understand what is true development versus what may be something else. And so that also requires a detailed analysis to carve out the development costs from those other costs. All right.
You want to go to the last slide on substantiation?
I do, because I think we've covered everything else. You covered the method change, everything else. I just added some, we're going to make the slides available. I added some stuff from the audit technique guide. The stuff that the IRS asks for is not unknowable. They want all the basics that go into your calculation. They want to know the prior year research history. They want to understand acquisitions and dispositions. They're going to want to understand the business components. Things that may be helpful. This is the IRS language here. It doesn't have to be this onerous as well. But as we mentioned, if you don't have time tracking, that's okay, but you want to develop something that in the end looks like time tracking based on the input from those that were close enough to the research and close enough in time to do it. And that's the other thing that was stated in this Kyocera is that they highlighted like how much farther in time it was in the analysis from when the research took place. And so we've been harping on this for years. That's why it makes sense to do it early, because you do get a little more audit protection in the sense that like it's harder for the IRS to say you didn't look at it contemporaneously when you did look at it like closer in time to when the research took place. I just want to give a huge thank you to Vivian. There's nothing as lovely as having someone do a first take on the slides and then having to be almost perfect, so I don't have to add very much. And so I want to thank her very much for her help on this, and everybody on our marketing team too who helps on this. So that concludes our webinar for today. I hope you got a chance to answer all the polling questions. Thanks, and again, if you have any questions, reach out. We do value your feedback. Take a short survey after this. It'd be very helpful. We tried our best to answer some of these questions in here, and I'll try to answer any more that I see in the chat. So thank you guys so much. Recordings will be available in about a week. Take care.